So today what I want to do is I want to spend some time talking about your presentations and papers which are going to be due on Monday, right? The first, what I'll call the first half or first draft. So what I'm going to be doing this semester is that your group valuation project is going to be split in half. So rather than having all of the grade happen at once, I'm going to divide it. 50% of the grade is going to happen on Monday, and then 50% of the grade will happen 2 weeks from Monday. Okay? And so basically, you're going to do a PowerPoint presentation, which is worth 7.5% of your semester grade rather than 15% of your semester grade on Monday. And then you're going to turn in your paper and corresponding valuation files, which is worth 7.5% of your semester grade on Monday, and then the other 7.5% in 2 weeks. So what will happen is the TAs and myself, and I've also made it so everyone is presenting on Monday, 10 minutes at a time in your PowerPoint, so all the teams present on Monday. The TAs will, and I will grade it, and then we will give you a grade and feedback. Based on that, you'll have a chance to improve upon that and then do another presentation 2 weeks later, right? Same thing for the paper. So we'll get the papers and the valuation files. We'll give you grades and feedback on that. So a lot of grading will be done next week. And then based on that, you can then turn in a revised version the first week of May at the end of the semester. This is also my opportunity to evaluate you to see whether or not I want to bring your presentations to external clients of the Smith School. Okay, so that's the other opportunity that I'm going to be evaluating based on the presentations. Right? But in either case, you will do 2 presentations, you will do 2 papers. The first ones are due next Monday. 7.5% of your semester grade is the PowerPoint, 7.5% of your semester grade is the paper and corresponding Excel files. So that's the first part that's due on Monday. It's due at Monday at 10 a.m. for all sections. So make sure you submit everything as a team by that deadline. Okay? So if you're late, it's bad for your whole team. So don't be late. Question?
Will both the presentations be on the same company?
Yes. Yeah, so your presentation is the same. It's just, and the other way to distinguish between the 2 presentations is that presentation number 1 is what I like to call the technical presentation. So the metaphor I was using earlier is, let's say the Summer Olympics are coming up and you see that somebody's, running down, they're going to do the vault and spins and flips and stuff like that. And you're like, wow, that was amazing. And then you see the judges give them a score that's really bad. So Monday is the technical presentation. So there are just technical things that you must cover in 10 minutes. And we are going to be looking for those. And today in class, I'm going to be covering those. And that's Monday's presentation, right? So you must cover those. And if you don't cover those, it will hurt your grade. In 2 weeks, what I'm going to do is I'm going to say, okay, focus on what's important. So you've covered the technical. So then redo the presentation. You're like, it really matters for these things, so I'm just going to spend my time on this. So the second one is a little bit more open-ended in what you can cover. The first one, very technical. Same thing for the paper. The paper must cover all the technical requirements. It's really the academic presentation that you must make, right? And that's what Monday's about. But rather than just doing it all at once, and if something is wrong, I'm giving you a chance to improve it so it doesn't kill your entire project grade. So you also get a chance to get feedback and iterate once to make it better, right? So that's the other reason I'm doing this, because in past semesters, I used to make it just all due at once at the end of the semester, and I felt bad for some teams which just didn't do a good job on something, and they could have done better, but they didn't have a chance to improve. So this is the other reason why I want to do this. I want to set everybody up for success, so that's why I'm doing today. I'm going to be very specific about what it will take to be successful in that presentation. And this is your chance to ask questions about this. Right? So with that in mind, I put up an announcement earlier this week called the Group Project Valuation Requirements. This is the template. So for both the paper and the PowerPoint and the spreadsheets, think of it this way. Somebody asks, what's the rubric? This is the rubric. So the TAs and I are going to listen to your presentations. We're going to pretty much have a checklist. And we're going to be ticking boxes. And if there are boxes that are not ticked, you're going to lose points. So these are all the boxes that must be ticked. Right? And that's very important that you understand what they are. We're going to try and go through those clearly. Now here's the other thing. You're presenting the same data with 2 different venues. So basically, you're going to do the PowerPoint, and we're going to grade the PowerPoint as the PowerPoint. and then you're going to write the paper, and we're going to grade the paper as the paper. So even if you said in the PowerPoint and you don't say in the paper, when we read the paper, we can't give you credit for it. Right? And the same thing, even if you've turned in your paper and your PowerPoint's like, hey, we put this in the paper, we can't give you credit for it in your PowerPoint. So you have to cover the exact same information in the paper and the exact same information in the PowerPoint, and they're just going to be parallel graded, independently graded between the two. And it is a group grade for all of your group members. Now, relative to the PowerPoint part of the presentation, you're going to make, again, a 10-minute presentation. Now, to be fair, I'm going to listen to 24 presentations along with the TAs on Monday. All right, so we have to get everybody done. So 10 minutes is the limit. So I'm going to have an iPad with my countdown timer. I'm going to set it to 10 minutes. When it hits 0, you're done. All right, I can't give you just give us 30 more seconds, because I would have to do that for the other teams. So just to be fair to everybody, it is 10 minutes. At the end of 10 minutes, you are done. Right? You are covering 4 sections. Each section has equal weight, 2.5 points of the 2.5%, 25% basically. So here's the thing. If you don't cover a section because you run out of time, your whole group loses grade for that. Right? So be very careful about time management to make sure you cover all the sections, because each section has an equal weight to the grading. Right? And what I have seen in the past is the biggest challenge is EIC, because people do the 5 forces industry analysis. And what will happen is somebody will do the presentation on behalf of the group. They'll spend 6 or 7 minutes on the EIC section, most of it on the 5 forces, and then they'll run out of time and don't get to cover the rest of the sections, and they could lose half their grade. And by the way, at that point, then the members of the team and the audience are pissed off because it's their grade that gets killed too. And then they go and they complain, they tell me horror stories, and then they complain to their parents call me. So I don't want to deal with that. So please, let's not deal with that. So make sure that you come prepared and you know how it's going to be. Now back to this. With the presentations, everyone must be here. Today, Monday is a mandatory attendance day. It's been on there since the beginning of the semester with the syllabus. If you are not here and you do not have a university-approved absence, you lose 5% of your semester grade, whether you're presenting or not. Okay, so you must be here, and we will take a physical attendance to make sure that you're here. Okay, so here's the point. It's up to you to decide who's presenting on behalf of your team. If you have 7 team members, I would not recommend all 7 of you trying to present. I used to do that a few semesters ago, but then I gave everybody 1 presentation in 20 minutes. Now you have 10 minutes and 2 presentations. So in 10 minutes, 7 people, not efficient. So it's up to your team, but you can decide 1 person could do it all, 2 people, 3 people, but figure it out. They have to do it on behalf of their team in that time period. I've also noticed that particularly for the presentations, there's a tremendous disadvantage to going first. The grades get better as the presentations go on, and particularly as the day progresses, because whoever goes first, everybody else is watching them, and they see their mistakes, and they see what they're doing well. So what happens is the later groups can say, we forgot to talk about this, so let's talk about this. Or they talked about this, and this is really good, so let's make sure we talk about this. So here's the thing, to try and mitigate that, whatever you turn in at 10 a.m. in your PowerPoint is all that I'm going to allow you to be graded on. So for example, if you forget to put in an implied multiples and the sanity check that I talked about on Monday, and you realize this, and you start talking about the implied multiples, I can't give you credit for it no matter what you say. So again, you must put in all of the data to support what you're going to say in the PowerPoint. So take screenshots, embed images, put all that into the PowerPoint. You can't go off PowerPoint. You can't go to any other files. Just out of fairness to all of the groups, you can only present what you turn in before I start all of the presentations. Obviously, the papers, you're not going to be presenting those. Those are going to be in there. But it's 10 minutes. It's a team grade. And here's the other thing. Based on my experience, the other thing that really hurts grades it comes down to 2 things. 1, timing. Because what will happen, not saying it will happen to you, but basically you'll have 3 people putting the presentation together the night before. They don't talk to each other. they show up and their timing is completely out of sync. So the 10 minutes is not managed well, and it's really bad for the team. Or problem number two, and this is where you'll see the TAs and I will sometimes chuckle. If we're laughing, really bad things are happening to your grade. The reason we will laugh is because you'll say contradictory things, right? So basically what will happen is somebody in the EIC will be saying, this is a horrible industry, it has no spread, no competitive advantage, it's a commodity, this is just a terrible business. And then the valuation comes along, strong buy, growth rates of 10%, improvement of margins, we love this company. And we'll be like, they're in the same team? This is where the chuckles will start. So don't have that happen to you. Contradictions in your 4 sections will result in dramatic grade loss for your team, even if you're covering technically correct details within the sections. Because the point is you're giving a holistic view of a company, not independent views that don't sync up. So again, I know particularly for the paper, this also comes up because you split it out and one person writes one section, another person writes another section, etc. You just cut and paste it all together and you submit it. Like, I understand that. It's the way the world has to work, but I'm just telling you, talk to each other. Make sure that you're not saying anything that starts to contradict what the other people are saying, because everything should support the eventual conclusions that you do, and when it doesn't, that's the other thing that's really bad for grades. Okay, so just giving you some advice so that doesn't happen to you. I'd like to see you guys set up for success for this presentation. Finally, dress code. I'm not for this Monday asking for professional dress. Okay, if we end up going in front of external speakers, then yes, there would be professional dress, but you will know that in advance. For Monday, you can come business casual. However, don't come as if you're going to the beach. Okay, so no flip-flops and shorts and bathing suits, and I'm just here with a margarita in my hand, assuming I can drink, and I'm just happen to be listening. Like that, I'll still knock off 5 points of your semester grade. So you must take this seriously. Again, you don't have to be professional, but don't be unprofessional. Okay, so that's what I'm asking for all of the members of the teams, presenting or not. Okay, because I want you to be respectful of all of the people that are presenting. And another minor issue, again, I know that the average person uses their cell phone for 4.5 hours every single day. And if you basically go more than 20 minutes without it, you'll start to suffer. So you'll be tapping on your phone, or worse, tapping on the keyboard. And it's really just, it's to some degree disrespectful to the people that are presenting. So no clacking away on the keyboard or other things that are just making it hard for the people presenting. Because again, the people that are presenting, I mean, obviously they're going to be nervous. They put a lot of time and attention. This is very important to them for their semester grade. We just all need to be respectful about each other. So I'm just asking in advance so it doesn't have to come up on Monday. Let's just be respectful. I know it's tough, but let's spend 70 minutes actually just listening to each other and just be respectful of the people that are in front of the room, because it's going to be really tough on them. We don't want to add to their burden because they hear clacking of a keyboard constantly while they're trying to remember what to say. If you need note cards or anything else, feel free. Right, so you help yourself. So if you want to be scripted, I don't have a problem with that. I'm not going to give you speaker points. Right, I'm going to basically care more about what you're saying than exactly how you're saying the message. So don't be too nervous about that. Right, so just make sure you cover the materials. So let's get into the materials, but before I do, questions about any of that? Yes, sir.
Section 3 it says you must do this analysis and then 2 additional companies.
Yep.
Your peers.
Yeah, we're going to, give me a couple minutes, we're going to go through that. So I'm going to go through each section and be very specific. Okay, so let me come back to the multiple section. Other questions about the general stuff before I get to specifics? Yes?
I was supposed to go over the rule there on the presentation.
Again, I'll cover that when we get to the valuation, because again, in 2.5 minutes, there's only so little time you have, so I'm going to tell you more about what I expect. So I'll cover that as well. So really good questions. Make sure we get to those when we get to those sections. All right, so let me start out with the EIC. And let me also make one other general comment. Now that you've been here for almost 3 months, time does fly. Hopefully you realize that what's important is not just making statements, but supporting it with data, right? So that's very important. is you can't just make an assertion. Everything has to have data to back it up in the paper and in the PowerPoint. So remember that as we go through, because that will also affect your grade. So let's talk about section 1 is EIC. All right. The key to EIC, and I said this on the first day of class, and I'll just remind us of this, is that approximately 50% of a company's performance is going to be based on the external factors, we'll call it the E and the I. All right. So basically, that's what we're trying to understand. So if our company was ExxonMobil, the fact that oil is $40 a barrel, and at $40 a barrel, nobody's making money, and the economic conditions that support $40 a barrel are really bad for the oil and gas industry, that's the insight out of the E and I that I should be coming up with. Right? So obviously we're giving some very technical ways of getting through the data, but if you really think big picture, why are we doing an EIC? We're just trying to understand how much does this industry, how much does this economy affect, and what is the impact on the company's current level of spread and ability to grow. Question? Yes, I am. This is being recorded and will be posted on YouTube. All right. So here's the point. Let's talk about E. Right? Here's a company. All right. Somebody earlier asked me about Black & Decker, so I happen to have that up. All right. So Stanley Black & Decker. So if I go to RV and if I go back to the Bloomberg peers. If I go to RV and I go to markets and I go to beta, like this is probably the screen that I would recommend rather than just the beta screen, because it gives me the beta for the company and the industry, right? At least based on the peer groups. So here's the point about both Black & Decker and its tool selling peers. The industry beta is 1, and Black & Decker's betas, raw beta is 0.96, so it's pretty much going to be sensitive to the economy. At the end of the day, that's what matters. That's what I need to hear you say. And this is what I mean by data. You have to show me the data, so I see the 0.96 to support your conclusion, as opposed to somebody who just walks in and says, I think Black & Decker is sensitive to the economy. Well, you could have made that statement 3 months ago without taking this class. Like, that doesn't tell me anything. So why? Again, the key is to why. All right, that's what you got to give me. And so this is a screen that helps me do it. This is really all you'd have to say about the E section to Black & Decker. Right, and here's the data to back it up. So then I go to the I. To do the I would go to the RV screen. And on the RV screen, we did a template called Homework 2, if you remember it back in the day, where we calculated the operating spread for the peers. And so when I think about industry attractiveness, an attractive industry has a positive spread. So Black & Decker's industry is attractive. It has a positive spread of 8.24%, or percentage points, 824 basis points. Competitive advantage. Black & Decker is not demonstrating advantage because their spread's only 3% when the industry spread is 8.24%. Okay? That's what you need to say. This is the screen that you need to say it with for the I and the C. Now let's go back to the I. Why does this have an 8% spread? You're going to have to reference the 5 forces, right? Buyer, supplier, substitutes, entry, exit, rivalry, overall, today, and what we think is going to happen in the future. By the way, that's 12 items, okay? Now, if I did 15 seconds on all 12 of those items, that's 3 minutes, right? And you will run out of time in your presentation because you have 2.5 minutes to do the section if I spread it out evenly. This is where teams run into trouble, okay? So let's be specific. On your PowerPoint slide, I would expect, and this is the way that I do my presentations professionally, I have the data on my slide, and I don't just read the slides, I tell them what is most important, but I have the data behind me so they don't think I'm just making stuff up. Okay? So here's the point. You have the 5 forces, the table, and maybe a couple of bullet points written for each one, and then you tell me what's the most important one. So I'll give you an example. For Stanley Black & Decker, I think the reason why this is an attractive industry, there's not that many large tool companies, And so therefore, with that lack of rivalry, I think it helps the margins in the industry. However, competitive advantage. I think the challenge that Stanley Black & Decker particularly has, which is why they're earning less than the industry, is because their sales are concentrated at Home Depot and Lowe's. And given that level of buyer power over them, that it's harder for them to do well than some of these other players, which are selling beyond Home Depot and Lowe's and selling directly to companies. And that's why I think their returns are lower than others, and they're not demonstrating competitive advantage. That's the analysis I would give for the EIC. So I would expect that you're A, referring to numbers, B, giving me the insight, and C, giving me the highlights. Right? And by the way, I could have put that entire story together in 2.5 minutes, but I got to know my company in order to make that. Here's what's less good. Less good is Stanley Black & Decker doesn't have competitive advantage because they have a 3% spread and the industry has an 8% spread. Notice I'm not saying anything else. Right? That's less good. Right? Here's where you'll get no credit at all. Stanley Black & Decker doesn't have any competitive advantage compared to their peers. Okay, I want you to think about those 3 statements. They're all on YouTube. And I'm just going to think about the way we're going to grade this. So statement number 1, you get full credit. Statement number 2, you get partial credit. Statement number 3, checking my watch, wondering when you're going to be done. Okay, so don't do statement number 3. Don't just talk about platitudes. You didn't have to take this class to say statement number 3. So that's what's key. Help me use the data we've learned in this class to explain the things. That's what you need to cover in the EIC section. And again, approximately 2.5 minutes. Now on the paper, what do you have to do in the paper that's different? The paper, I am targeting based on historical reference. There's no set limit, but I'm assuming approximately 12 pages of analysis and about 3 pages per section. Again, that's not a minimum. The actual answer is as long as it takes you to write the questions. If you can write them faster and shorter, then you don't need 3 pages. If you need more time, you can do more than 3 pages. But 3 pages is a guide. Now here's the other thing. I'm getting old, so therefore minimum 10-point font. Right? I prefer 12, but 10 to 12-point font. And I prefer double spacing. It's just easier to read. So that's just kind of a guide. And finally, embed the exhibits. So just like you're going through the PowerPoint, and there should be a screenshot of the betas and a screenshot of the RV screen, and maybe a screenshot of the table of your summary of the 5 forces, those screenshots should also exist in the paper. Minimum in the appendix, preferably embedded in the section for EIC, so it's really easy as we're grading it to see the data. Right? So again, you're going to have to do both screenshots in both sections. Now somebody asked in the last class, they said, well, what if we reference IBIS World? Is that okay? The answer is absolutely. So if you want to talk about how IBIS World said something, just don't plagiarize. Okay? So I'm not expecting formal footnotes. It may be nice, but make sure you at least reference the IBIS World report, right? So you're not taking credit for somebody else's work. And if you wanted to take a screenshot from IBIS, like for example, the industry growth rates included in, there's nothing wrong with that. So you can always give me more information I'm asking for. But as I said, make sure you at least give me the minimum screenshots that I am asking for. So that should cover the EIC section. Questions about EIC? Okay. So section 2, historical analysis. The reason we're doing historical analysis is not that the past predicts the future, but by understanding the past, it will hopefully give us some basis to better predict that future. It infers the future. So there's 2 types of historical analysis that you are going to be responsible for. First, and I'll go back to our Whole Foods assignment. So if I bring up the Whole Foods model, and I go to the tab called ROIC drivers, this is automatically created for you, and it's basically a tree of the ROIC for your company for the last 5 years, right? And so what I need you to cover in this, I think a little over a minute, got 2.5 minutes for the section, minute, 15 seconds, is I want you to explain that the ROIC for Whole Foods went from 11.8% to 12.5% over the last 5 years, and why. At a high level, 3 reasons. Either the tax rate changed, the margin changed, or the productivity changed. So as a minimum in the PowerPoint, which of those 3 or combination of the 3 caused that change in ROIC? Now, in your paper, you can drill down a little further to talk about which parts of the margin changed and which parts of the productivity changed even further. But for your PowerPoint, I don't think you're going to have time, but at a minimum, this should be a chart, a table that you copy and paste into the PowerPoint file, right? So here's the thing. Again, let me give you good, better, best, right? Here's bad. This is what you shouldn't do, okay? So what you shouldn't do is you shouldn't say, in 2011, Whole Foods ROIC was 11.8%, and then it went to 2012, it went to 14.9%. 2013, it went to 16.4%. 2015, it went to 15.1. 15.1. In 2015, it went to 12.5, because in 2011, the tax rate was 38.5%. 2012, 38.5%. 2013, 38.8%. 1, you'll never finish, and 2, all you're doing is reading to me numbers. Right? So when I say refer numbers, I'm not just asking you to regurgitate what's on the screen. So that would not be the way I want you to do the analysis. I also don't want you to do this. Whole Foods ROIC improved over the last 5 years because they got better margin and they improved their productivity, and those were the primary drivers of the improvement in ROIC. You also get 0 credit for that because, again, those are platitudes that you could have just flipped coins and done Mad Libs, and you could have potentially been right, or wrong, and it's just very generic. So, what am I really looking for? More along the lines of this. Whole Foods ROIC in 2011 was 11.8%. In 2015, it increased to 12.5%. What was primarily behind this is the cash tax rate stayed about the same from 38.5 to 39.7. So really, if I look at the other 2 drivers, it was the improvement of operating margin from 5.4% to 5.6%, a 3% gain, and it was simultaneously an improvement in productivity as invested capital to sales went from 0.28 to 0.27. That was those operating margin and productivity gains are the primary reasons why Whole Foods ROIC improved over the last 5 years. That's what I would find to be more ideal. Okay, so again, about a minute and a half. Now, in the paper, you can go a little further, and you can say, okay, well, the operating margin improved because, and you can talk about the change in the gross margin was better for Whole Foods, so getting better markup on their food, whereas the operating cost, the SG&A, stayed flat from 29.6 to 29.6. Well, the gross margins went from 37.8 to 38, right? So it was really improvement in gross margin and a slight change in depreciation. But it was the gross margin that led to the operating margin improvement. And the capital, I could go through that. So again, you can go another level of granularity in the papers. I don't think you're going to have time to do in the PowerPoints, but that's the minimum I expect for the ROIC chart. Okay. Second, historical analysis. Again, another approximate minute and 15 seconds. CFI. What you need to do, and you did this on several homework assignments and in class, is basically take the 5 years of historical CFI and analyze it. No different than in the midterm or other graded assignments. And again, same concept. Don't just say generic things without referring to numbers, right? And make sure that you don't go through every single number because you won't have time. So focus on what's important. So again, here's what's less good. Whole Foods free cash flow declined because its gross investment increased. That's not helpful, right? Whole Foods free cash flow went from $240 million to $110 million because Whole Foods reinvestment rate went from X to Y between 2011 and 2015, right? And because they had positive free cash flow, Whole Foods did not need to do any debt. They issued no debt, and they used their positive free cash flow to pay out some dividends, which were increasing from $52 million to $184 million per year over the 5-year period of time. Okay, that's what I'd rather hear you talk about with Whole Foods. Again, giving me the highlights, telling me kind of the key points of the sections and helping me put that puzzle together. Okay, that's the historical analysis section. Questions about any of that? Yes, sir.
So say if they had a lot of reinvested capital, do you want us to tell you like what specific projects they did?
It would be nice. I mean, I actually love that type of data. If you don't have time, like this is when you either in the paper or as I said, you're going to get a second chance at the presentation where in the next 10 minutes, the second 10 minutes, I'm not going to basically say you have to cover everything again. You can spend more time on certain issues. So that's a really good differentiator. But again, I think the more you know about the company, the better. And I'll give you a perfect example. So in the last class, we're getting ready to talk about the multiple section. Somebody didn't have a price to book multiple. And they're like, what do you want us to do? And I said, well, the reason you probably don't have a price to book multiple is the company probably has negative equity. So I said, look it up. Go to the FA section. And sure enough, the company had negative equity. It was AMC Networks, theater chain. And they started with negative equity in 2009. So I don't know what happened in 2009 that caused their equity to go negative, and neither did the team. But I was like, it'd be kind of interesting to know. So even though they couldn't do a price to book multiple because the company doesn't have any equity, like what caused them to have negative equity? Obviously, there's some event that happened to the AMC theater chain that's probably relevant because if nothing else, this is the key point to why we're doing this. I know you're probably thinking, I just have 4 sections I have to do for this assignment, so I'm completing it out. But these sections should help the next section. So if there's something that happened to AMC, the theaters as opposed to the network, that's causing them to have problems, is that something that's going to spill out into my future valuation? So maybe I need to know that. So look, like that's what I'm saying is this historical analysis with Whole Foods, the trend is relatively boring, but what I'm getting out of the trend of Whole Foods is that particularly in the last few years, their investment intensity has been going up. I don't have it on the screen, but the reinvestment rate's been going up. And so one of the things I have to think about Whole Foods in my valuation going forward is that going to change. So for example, I told you to leave the balance sheet alone, but maybe we actually decide to change the balance sheet ratios for Whole Foods because maybe they're not going to reinvest at this rate going forward because they're not going to open up as many stores going forward, and that's going to change their free cash flow going forward. So again, the past infers some of the things that will lead to our future valuations. Other questions? Section 3, multiples. Again, we'll talk about it in terms of Whole Foods because you did this as an assignment. So please format it better than I did, right? Because this one's not formatted very well. But regardless, this was the multiples that I took, I think, over the weekend for Monday's assignment, or whenever we did this, and I basically cut and pasted it into the model. So here's the idea. When we do multiples, first, you have to have at least 6 peers, right? And part of the reason why I want you to have 6 peers is because if I go back to Stanley Black & Decker, I don't know if I have a true, because Bloomberg is curating this list. I don't have a true representation of the tool industry because I just have so few companies on this list. So I want you to have 6 peers so you have a better market cap weighted average. Now, if our industry were Home Depot, and it's really just Home Depot and Lowe's, okay, maybe Ace Hardware and a couple of others, but they're really the industry. But here's one way to check this out. Go to Bloomberg as the comp source and switch that to the Global Industry Classification Service, or standard. And suddenly you'll notice that my list is 50 companies long. So I could add peers manually, or I can go to the GICS peers and I can expand my universe. But notice that now the data has slightly changed because there's more peers in the list, and I think I'm getting a better representation of this industry than just with 4 players. Yes?
If you're adding global,
I'm still in the US, by the way, but go ahead.
well, I mean, if you're increasing it, does the EIC change?
Yes, it does. So whatever you're doing in the EIC, that's a good point, you should do for the multiples. So the people doing the EIC should use the same list as the people doing the multiples. So don't do 4 peers in EIC and 50 peers in multiples. That's not good.
So you don't want us to go outside?
If you think it's appropriate, you're welcome to go outside the US. So if the industry that you're in, like for example, if I'm doing pharma, right, and my company is Pfizer, well, GlaxoSmithKline, which is not based in the U.S., they're a London firm. They have a U.S. headquarters, but they're a London firm. I probably want them in my analysis because they're just such a big global pharma. So for pharma, I probably do want that. If I'm doing, I don't know what the other industry, trying to remember what the other industries are. If I'm doing, say, defense and aerospace peers, I probably just want to stick with the U.S. defense and aerospace peers. Right? So again, you could use some judgment here, but nonetheless, use the same peer groups. That's a really point between the two sections. Right? Oh, no, the other one's healthcare. So again, probably stick with U.S. healthcare peers because outside the U.S., the healthcare markets are completely different. There's a lot of government-sponsored healthcare, so you wouldn't use an insurer in the U.S. and insurer in the U.K. It's the same market. All right, so back to this. What do I need to do for multiples? Let's go back to Whole Foods. First, my company that I'm doing the analysis on, in this case Whole Foods, against the industry average. So what you're looking at on the screen, these multiples, are an expression of growth and return. So what I said is I want you to tell me, is the company trading at a premium or discount? And what you're seeing for the market cap weighted average is an average growth and spread. And if growth and spread are the primary drivers of multiples, what does it say for my company against the industry for growth and spread? So somebody asked earlier, where do I start? Start with trading at a premium or discount, so start here. Enterprise value to EBITDA, enterprise value to EBIT, PE. Is Whole Foods trading at a premium or a discount compared to its peers? Yep.
Slight discount for the most part.
All right, and what numbers are you using to say slight discount?
The 7.14 compared to the 7.56 to 11.43.
Okay. How about the 1876 versus the 1657? Okay. So this is why I told you this isn't a Harvard Business School class, because we don't give you elegant answers. You got to get involved with something that's messy. And this is an example where we have two multiples that are actually telling us slightly different things. They're trading at a premium for the PE. They're trading at a discount for the enterprise value multiples. Right? Now, we mentioned this in class. What did we say could cause a difference in the PE? I'm sorry? Yeah, there could be some dilution because of cap structure or some accounting items or some non-operating gains and losses. So that's what I'm just saying. We got to be careful. That's why I like to look at all three ratios, that there could be something going on that's affecting the PE ratio that could be affecting one of those things that we just talked about. Again, I don't know without doing investigation, but at least I should be clued into that. So next, look at the growth rates. Whole Foods is growing earnings, proxy for long-term growth, at 8.52% and per year, and the industry is growing at 10.56%. So Whole Foods is growing slower than the industry, about 15% slower than the industry. Right? So, given that, why would they be trading at a premium or discount? We got to look at their spread. Well, our two indicators of spread as multiples are PEG and price to book. Price to book for the industry is higher at 4.68. For Whole Foods is lower at 3.05. PEG for the industry is lower at 1.61. For Whole Foods is higher at 2.2. So here's my next thing. These are kind of conflicting. Okay, they're not in sync. So I got multiples a little bit out of sync, and I got the things that would drive the multiples a little out of sync. So now I have to make an educated guess as to which I think I'm right on. So here's my premise. I think, by looking at this data, that Whole Foods ROIC should be, if I just focus on the PE, should be higher or lower than the industry average. If I just focused on the PE, given this growth rate, should the ROIC spread be higher or lower than the industry average? Higher. And what supports that is the peg of 2.2 versus the peg of 1.61. Everybody see that? Given that you're just starting out with this analysis, if you say that, I will give you credit. Because what this analysis is really about is getting you to think in terms of expected growth and return and how multiples are a representation of that. And the fact that you can tie that together to explain the PE, I'll call that a success. However, if somebody else looking at Whole Foods were to say that despite the lower growth, they're trading at a discount and their price to book is lower, then I think they're trading at a discount because they probably have a slightly lower spread and a slightly lower growth rate. I would also give credit to that statement because it is also a logical way of explaining those two enterprise value multiples for purposes of this assignment. Now, here's the thing. In an ideal scenario, I'd like to reconcile those two to figure out who's more likely to be right. So that's more advanced, and it would be great if you could cover that in the paper, but if you can't, I'm not going to hold you to that standard because, again, you're just learning. Right? But at least if you could tell those two scenarios, that's a win for me. But let's go a step forward. So what do you think? We know their growth is lower. That's just the long-term growth rate the analysts are using. So let's believe that's right. So why would their multiples be like they are? Do I think Whole Foods has a higher, lower, or similar spread to the industry? What do you actually think? And by the way, two other things you could do. We have the formulas for these things. We got the key value driver formula. We got the enterprise value to EBIT formula. Just like we did an as-is for the company, we could actually do an as-is for Whole Foods using the multiples formulas. So we could recreate these multiples using growth, EBIT, etc., and basically try and come up with this, right? So that's one thing we could do. But I'm not saying I'm asking you to do the standard, but we could do that. So let's say we're not going to do that. Look at the enterprise value to sales and look at the estimated margin for Whole Foods compared to the industry. What does that lead you to believe? Does Whole Foods have higher or worse margins than the industry? Better? Okay. So let's assume these are all grocery stores at the end of the day. If the grocery store margin at Whole Foods is a lot higher, then what would you think about their ROIC compared to their peers? If their margins are higher at Whole Foods? Is Whole Foods just wholly inefficient? So one of the things I could do is I could say, okay, I'll infer because of their higher margins that actually I think their ROIC is probably a little bit better than the industry, and I tend to believe the PEG ratio more so than the distorted price to book multiple, and so therefore I'm going to lean towards it's the lower growth that's causing them to have a slightly discounted multiple, not a lower ROIC. All right, I'm not saying I'm right, but I'm saying without further investigation, if I had to think about it as a scale, I'll put more on the scale of higher ROIC and lower growth than I will lower ROIC and lower growth because of that higher margin. Okay, so again, I'm not saying with 100% certainty, but I could probably make that assertion to try and break the ties between those conflicting ratios. But I probably also would want to figure out what's going on between EBIT and net income that's distorting the PE and potentially distorting their price to book. You know, were there some write-offs that they did that distorted the price to book that's making it look higher than it probably is, etc. I could have done that external research. I'm not holding you that standard in your 10-minute presentations, but if you really were to dig into this and you work for JP Morgan, this is what you'd be doing. You'd be ripping through those statements, you'd be ripping through the 10Qs, you'd be trying to figure out what's going on. You'd be talking to the accountants, you'd be talking to the auditors. Yeah.
If you don't have the PEG ratio, you just go off the.
If you're missing data, you go with what you got. Right? So I'm just saying, like, well, first of all, If your company was Weiss, I would have told you to find another company. Because if you have no multiples, like it's hard to do a multiple analysis, right? But in this case, if you're missing a number, like for example, if you're Fresh Market, then you're going to probably have to do some inferring when you don't have a number, right? Because my guess is they're probably losing money, and that's why they don't have a peg. And that's why they don't have a long-term growth rate in earnings, because they don't have earnings. But again, I don't know. I'd have to do some analysis on that, and then I had to make some inferences. But here's the point. What I would know is Fresh Market, for example, has slightly better margins than the industry, but they're trading at discounts to EBITDA. They're trading at about the same as the EBIT and PE. So slightly difference between those two. And their price to book is positive. So I'd say that there's something just going on with their earnings. And I don't know what it is. So maybe they're just having a series of write-offs, layoffs, restructurings. I don't know. That's not really affecting their core business. As I said, we'd have to really dig deep into Fresh Market to answer that. But that's not one of the companies you guys are doing. All right, so here's the next piece. You do your company against its peers. So let's go back. For Whole Foods, Whole Foods is trading at a premium in the enterprise value multiples, enterprise value to EBITDA of, Whole Foods is trading at a discount in its enterprise value multiples, 7.14 against 7.56, 11.43 against 12.45. Whole Foods is trading at a premium with its PE of 18.76 versus an industry of around 16.6. Whole Foods' long-term growth rate is about 15% less than the industry at 8.52% per year versus 10.56% per year. Given that and the PEG ratio of 2.2 against 161, I believe that Whole Foods' lower growth implies a slightly better spread with a higher PEG, which is why they're trading at a premium for PE and trading at similar enterprise value to EBITDA and EBIT multiples. Two other companies. Once you do Whole Foods, pick two other companies off of your list and then try and explain it, premium or discount, growth, spread, and how you did it. Now here's my recommendation. Pick two easy companies. So don't find the complicated Whole Foods company. Find a company that's a little bit more straightforward and easier to explain. So pick two more. So what's important to me in the grading is that you can start to relate and practice figuring out the growth spread combinations as to why multiples are higher or lower. So if you got a really easy story and you can explain it that way, I'm perfectly fine with that. So you don't have to explain the entire industry, but I do want you to practice on two additional companies against the industry. So with that in mind, why don't we take a company like, I don't know, we'll do a different one off of this list. Sprouts. What could we say about Sprouts? Trading at a premium. And we would specifically name the 11.44 EBITDA, 15.05 EBIT, and 25 PE. Okay, why?
Because their estimated margin is higher, and their PEG ratio is lower than the average.
Okay,
And then
okay. What else? Somebody else help out. Yeah.
They have really good long-term growth.
Yeah, their long-term growth rate is
17%.
against an industry. So they're almost 70% growing faster than the industry. So why do I think Sprouts is trading at a premium? Why do I think Sprouts is trading at a premium? Put all that together. I think it's their very high growth at a positive spread, but I don't think the spread is that much higher than the industry because their PEG is 1.4 against an industry of 1.6. All right. So again, price to book could be distorted, but regardless, here's the point. If I have a high growth and a high spread, I have a ridiculously high multiple. If I have a high spread but not a lot of growth, I don't have a high multiple. If I have a high growth and a low spread, I don't have a high multiple. So what causes me to have a substantially higher multiple? High growth, high spread, much higher than the industry. So in this case, what I can infer is they got a lot higher growth and their multiples are higher, but they're not exponentially higher. So I think it's really a lot of growth that people like at Sprout, but positive spread, but not that much different than the rest of the industry because the peg is kind of close. So people are paying more for Sprout because of their growth, right? And you might say, why are we even doing this analysis? This is hard because this is future expectations 101. So when I'm doing the valuation model, I should be thinking, what should I be thinking about my long-term growth rate for Sprout? I should probably be thinking that Sprout's going to be having percentage growth rates higher than the rest of the industry because that's the way they're being priced by the multiples when I'm doing my as-is valuation. So yes, I can go look at IBIS World and I can look at industry growth rates, but I can infer from the market pricing and the growth here that the analysts are predicting that their growth rates are going to be much higher than a Whole Foods or some of the other companies. So it will help me when I do my as-is, plus I have an estimated margin that I could use for Sprout as well, so that will help me when I do my as-is, right? That's the other reason why you're doing a multiple analysis, is these are not independent sections. They should be helping you sync up with your valuation. And this is, again, another source of potential contradiction, right? Because the person that does the multiples goes up and says, the multiples tell me this company's not growing and has a terrible margin and a terrible return. Then the people doing the as-is and the final show me all of this growth and all of the buy and all of the spread that this company's going to have in their valuations. And those sections do not sync up. And therefore, there's a problem in your valuation. So again, I'm going to be grading this holistically as I'm listening to your presentation. And the people that talk about multiples, which is probably the most challenging of the 4 sections that you guys are going to have to work on, make sure that those messages are consistent with the person that's doing the valuation section. Because if they're not, it will come out very clearly when you go right after another. So again, in 2.5 minutes, you're not going to have a lot of time to spend on multiples. So focusing on very quickly, premium or discount. This is the premium or discount. Here's why. Is it growth? Is it return that's causing it between those companies? That's what you're going to be talking in the PowerPoint. In the paper, you have more time to write it out, but that's what you want to do. So let's try one more. Kroger. Big grocery store chain, Kroger. What would you say about Kroger? Yeah.
Trading at a discount.
Okay.
They're all their, I mean, the PE, EBIT, like EV over EBIT, it's all below the industry.
Okay, so here's our industry average, just so everybody sees it. And then you're talking about Kroger.
Yeah,
So those 3 are trading at a discount.
then if you look at their peg, it's also below the industry, so that's probably why they also might be trading at a discount.
And you give me one more data point, and you got it perfect.
Then aside from the peg is the
Talk about the growth.
growth rate, slightly below also industry.
Yeah, I'm going to call 10.48 and 10.56 virtually identical. I mean, think about it as a percentage. Their growth rate's within 1% of the industry average. So yeah, it's a little bit low, but we're not talking about magnitudes different. So for very similar growth rates, they're trading at a little bit of a discount because the way you do that for similar growth and trade at a discount, and the PEG supports this, is they have slightly lower spread. That's what I said. He had it right on. Just, as I said, don't get hung up when you're 6 basis points difference in your growth rate. Like, yeah, it is a little different, but directionally, it's probably not going to have a huge magnitude on the actual multiple if you were to put that in the key value driver equation. So, so again, very similar growths. Kroger probably has a lower spread. The PEG supports that. The price to book doesn't. But as I said, I think in this entire industry, it looks pretty distorted. So it's harder to use that as a metric. Okay?
It's more or less like at industry, just slightly, like you said, just a few basis points on every
Yep.
ratio.
So again, I'm not saying back to spread. I don't think Kroger's spread is that much worse than their peers. So it's probably just slightly below average. Slightly below average growth, slightly below average return, slightly below average multiples. Right? And that's what I want you to get out of that. Now, if you wanted to go through the extra effort and just like we did the as is, pull out a spreadsheet and start cranking in numbers to support the multiples, great. You can try and do that, but I'm not asking you to do that level of difficulty. But if you're doing this in the real world, I would ask you to do that. But for class, I'm not asking, not for this presentation. All right, that's the multiple section. The person that asked about multiples, did that help you answer your question? Did I miss anything in your question earlier? I didn't want to forget about your question. Okay. Any other questions? Yes.
Do you expect us to present the other two companies during the presentation?
Yes. All three, 2.5 minutes. Focus on the highlights. Be succinct. As I said, if it helps to have note cards, whatever, like use that. I'm not going to, even if you're reading note cards, like I'm okay with that. Like don't feel that I'm going to grade you purely on speaker points, right? This is about a technical presentation that says you're covering all the key points we did this semester in the one for Monday. Same thing in the paper. Make sure you cover all of these points in the paper. Yes, sir.
You have to do a write-up on the Bull and Bear too.
We're going to talk about the section 4. Yes. In the write-up, you actually have to write up the bull and the bear. So let's talk about what's going to be in the PowerPoint. So let's go to final section 4. Section 4 is the valuation. 4 Excel files. As is, bull, bear, target. Turn all those in. Write them up in the paper. What you're writing up is your assumptions. Again, in 2.5 minutes, you are not going to have the time to go through the assumptions for all 4 of those Excel files. You're just not. So here's what matters. We said 3 things matter. Again, growth, EBITDA, margin, tax rate. Focus on the as is. What mattered most to your as is. What would cause the bull, what would cause the bear, and here's where we ended up on the continuum and why. That's what I kind of want to hear in 2 of your 2.5 minutes. Okay? So, somebody in the last class said, it seems kind of like the Morgan Stanley report that I showed you last week. And the answer is yes. Ironically, I was at Comcast, and I was in a presentation their head of investor relations gave, and he spent 15 years at Goldman Sachs, and he actually says that he thinks that Morgan Stanley does some of the best research on the street, even when he was at Goldman Sachs, because he likes what they do with their bull and the bear and the scenarios that they do. Okay, so they actually do some really good work, and this is what we're trying to replicate, the general idea of giving some scenarios. Now, as I said, in 2 minutes, you don't have time to get the scenarios. So what are you really trying to do with a company like, and I'll go back to Whole Foods. So if the valuation was $30 a share, okay, and let's just say we were at, the long-term margin was, what was it, for Whole Foods was 5.2. So this would have been 8.1, something like that. And this would have been, I don't know, 5.3, what do we say, 3? I think we were close, somewhere in that range. Again, here's the point. This is what I don't want you to do. I know what I asked you to do this semester, right? And so here's what I mean by that. You don't have to tell me that we went to Bloomberg, we got the EEO screen, we put the data in the EEO into here, we got the margins, and I used the margins to create the as-is. Like, I already know you did that. I taught you how to do that. So don't waste your time trying to explain the process that I know you already did. Okay, that's not what I'm going to try and grade you on. So I know you're really smart. I know you how to do this process at this point in the semester as a team. And the TAs and myself know you know how to do it. So we're assuming you're doing the process. So let's go right to the chase. What matters, when we did the as-is of 30/80, why am I using 3%? Why am I using 8.1% EBITDA margin? Why am I using that tax rate? This is why. Okay. Now, when I think about Whole Foods, I think the growth rate could be as high as, in a bull case scenario, 12% at these margins, and that would lead to this price. And I think in a bear case, the growth rate could be as low as X with these margins, and that would be the bear case. And our final valuation is we think Whole Foods is going to have this level of growth and this level of margin, which will get me to that price. And here's my buy, sell, hold. And here's why I think that that's the most realistic. That's what I want you to tell me about. Okay, that's your 2 minutes. right? So I don't expect that you're going to have time to go through everything. You won't. But I do want to hear a little bit of the why as to why you ended up where you did and why you chose the numbers that you did. So that's the fill-in for 2 of the 2.5 minutes. Questions about that? Okay. Finally, this is the last 30 seconds or so. This is what the Monday video was about. Right? In the Monday video, we talked about sanity checks. So sanity check number 1, it's called implied comps or implied multiples. Here's the idea. When we did the multiples analysis, this came directly from the trading multiples that we saw of the companies from Bloomberg. So we did section 3. We're trying to explain the expected growth return of the industry and of our company based on the trading multiples. Now, when we do the valuation, particularly our final valuation target stock price for the buy, sell, hold, we are doing intrinsic value and we are coming up with the theoretical value for the company. That's the theoretical price, $80, right? Well, here's the point. At an $80 price and this forecasted net income for 2017, then that would be a PE ratio of 46. That's what I'm calling by the implied multiples. So our valuation implies a PE at $80 a share of 46. Does that look reasonable? Because if I look at every other company in the industry, is any other company close to 46? So that's the point. If I think about all the companies that the professionals are covering, there's no publicly big traded grocery store chain that's basically trading at 46 times earnings. So $80 a share doesn't sound too reasonable. To get to $80 a share, I'm saying Whole Foods will have a 9% operating margin. Does any grocery store out there have a 9% operating margin? No, it's more than double the industry average. I'm saying that they would have an EV to EBITDA of 18 times. Nobody's paying 18 times EV to EBITDA. The best was Sprout, and they're growing 70% faster than Whole Foods. So do I really think that Whole Foods is going to get that much more growth than Sprout as a much bigger company with more returns? This is what I mean by sanity check. Like sometimes we start getting into the details of our model, we're putting in assumptions, and we're building assumptions on assumptions, and we start to get a little out of alignment. So it's just a way to rein us in to say, are we doing something that seems a little crazy? So that's sanity check number 1. By the way, if you have a hold valuation, our final answer is hold. Do the implied comps matter? If I have a hold, which means I'm very close to the current stock price, what do you think my implied multiples are going to look like? Yeah.
Very similar to the current.
So therefore, is that reasonable? By definition, yes. So the point is, technically, ticky-tack, you have to tell me that I'm a hold, we did the implied comps, here's the implied comps, we're close to the industry average, and that's all you have to say. The reason for doing the implied comps is when you get to the extreme edges of the buy and sell range, and you get to the very rosy scenarios or the very bleak scenarios. And so it's a way of saying, when I get out of the normal range, am I going too far afield of what's likely to happen, right? Then, same thing with the ROIC chart. So I asked you to graph the ROIC chart, and over time, we know that for big publicly traded mature companies, ROIC tends to move towards the cost of capital, tends to regress towards the mean, right? So what you don't want to see are what are called hockey sticks, right? Hockey sticks look like the Verizon logo, right? A big dip and straight up into the future, because that's not what we normally see. Could a company do that? Apple's one of the exceptions where it actually happened a decade ago, but it's very rare. So back to this. Does this look reasonable for Whole Foods at an $80 stock price? Look at these out years forecasted ROICs, and here's some of their better years, and here's today. Does that look right? That's a hockey stick, by the way. So that's what I'm telling you. I have 2 things that are telling me that the $80 share price is probably not going to happen, right? Because the ROICs have to be ever increasing into the future, and at the same time, we're seeing crazy multiples. So therefore, I would say that basically this is not a realistic valuation. Note what happens when I get closer to the as is. Go to the ratios. Here's 6. Here's 8. That one looks more reasonable. That's why you're doing the ROIC chart and you're doing it for the other one. If you have a hold, I'm probably not worried about these charts. But if you have a buy or a sell, they become more important because you're just saying, is what I'm doing reasonable? If you don't include these in your presentation, even if you have a hold, you're going to lose 1 to 2 points of your semester grade. You still have to talk about it. Right? So, final thing. Got about 1 minute left. That's the presentation. I know you had Chipotle as an assignment. I'll put up a solution for Chipotle later today, so we're not going to have too much time to talk about it. But I'm just curious, did anybody, because I was trying to answer the question, anybody do a buy on Chipotle? Just by show of hands. Anybody do a buy on Chipotle? Group assignment we just did? Any groups buy? Anybody sell? Anybody have a sell on Chipotle? Anybody a hold on Chipotle? Assumes everybody else? There were no buys, there were no sells, there were no holds. What did you say to Chipotle? Like, don't eat there, you're going to die? I mean, is that basically what you wrote? Like, what's going on with Chipotle?
It could be better and it could
That's right.
go very bad.
You think it could get better or go very bad?
It could be bad, it could be good or bad. So it really depends. It's unsure.
But what did your, I know it's a big range, so
Yes.
where did your team settle in the final? What'd you say? Did you say hold?
I think our result is our calculation. The price is actually a lot higher than the current value. But
Okay.
we don't decide to buy.
You're nervous, but why was the price higher than the current value in your valuation? What did you have that caused it to be higher?
Our result.
They had some multiple that was just so low that was like unreasonably low.
All right, so
The
here's
buy price was a lot higher for us.
So here's my final point. At the very beginning of your presentation, you could do this, or at the very end. Buy, sell, hold. All right? Don't just end with buy, sell, hold. Give me a sentence or two of why. This is your synthesis. So I think, and I'll mix metaphors, I think Chipotle is a buy. I'm very nervous about it, the bull and the bear, but I think it's a buy because I think at the levels of growth to support the current price, they would have to lose so many sales at such a low margin. It seems like that's going to be hard to justify over a long time, and I think they're going to recover. So if they recover to a reasonable price at this percentage growth and at this level of margin, their share price would be this, and that's why we think it's a buy. I think there's a lot of risk in this because our assumption is predicated on how soon they can recover to that level of sales, but that's why we think that they're a buy. And that's what's important about your analysis, because what you've done is she just synthesized the whole key to the Chipotle analysis. The fulcrum on Chipotle is how quickly and at what level they're going to recover to the margins and the growth rate. And so what you're telling me in your valuation that I would be willing to bet their team wrote up is they think, and you think on the multiples, that they're being overly penalized for something that's probably going to recover in a couple of years. And now's why I'm saying it's to buy, because the market is just like I'm avoiding this because I'm really worried. But this is a buying opportunity because they're probably not going to be at this another forever. Now somebody else could come in and say the opposite. They could say they're toast. Like nobody's going to want to ever eat there again. They think it's horrible. People are going to flee. You know, this is really bad. They'll never recover. And this is what's going to happen. And that's what the multiples are going to look like when they never recover. Now, again, both of you could potentially be right, but that's the difference between the buy and the sell, or the hold and the sell, or whatever it turns out to be. And that's why you think it's the buy, sell, or hold. So just finish or start your presentation with a word or two that summarizes the key issue for that buy, sell, hold to your target. Okay? That's what I want to hear. Right? Now, here's the thing. The TAs are having extended office hours this week. Leverage that. The TAs were in your shoes, either last semester or the semester before. They did the exact same presentations that you were doing. They can empathize, they can help. They're also going to be helping me with the grades. So feel free to talk to them, feel free to run ideas by them, feel free to practice with them. You saw Austin gave the announcement earlier today. So take advantage and leverage that before Monday. Otherwise, make sure you turn in everything, both paper and the PowerPoint, by 10 a.m. Monday for your group. And I did record today, and it will be on YouTube shortly. So you're also welcome to use this as a reference. But as somebody asked about the rubric is the announcement. That is what I'm looking for your presentation. Okay, look forward to hearing those on Monday, and otherwise have a great weekend.